So welcome to all of you Shiksha 360 CAD classes. Today basically we have to discuss the chapter number 10 ABFM, that is capital budgeting for international project investment decisions. Very important topic. Lot of numericals we have to cover in this session. So let's start. Basically first of all we have to understand the theory portion. After that we will move towards the numerical portion. Clear? Many of the things which we have to cover in this session we have already covered in the BFM. Here in the BFM chapter number 1. So first of all, introduction regarding that. What is the meaning of the capital budget? Capital budget basically that is capital that is basically for purchasing the fixed assets having long life duration. In simple language, we can say that. Same thing they are mentioning here. What is the meaning of the capital budget here? The capital budget basically it is determined by the company management to plan expenses on the fixed assets. Clear? So what is the capital budget? The capital budget basically it is determined by the company management to plan fixed expenses on the fixed assets. So the objective of the capital budgeting basically is to make long-term expenditure decisions. Clear? So what is the objective of the capital budgeting? Basically is to make long-term expenditure decisions about whether particular projects basically will result in sustainable growth and provide the expected returns. Clear? What it says that basically capital budgeting basically it is to make long-term expenditure decision. Clear? That is basically what we have purchased these assets basically will have long payback period. Okay, long expenditure decisions about whether particular projects basically will result in sustainable growth and provide the expected returns. So using the capital budgeting approach, each suggested capital investment decision is given a quantitative analysis in order to have a rational approach basically towards the business decision. On the similar lines, making investment abroad. Clear? So this is regarding the investment in India. Similarly, on making investment abroad and to that it is in a project requires a serious consideration of many issues, especially because the investment need to be factor in multiple aspects of a foreign territory. Clear? So like where basically we are investing, what is the environment at that place, or what is the rules and regulations or laws, what is the culture at that place, political stability are unknown and unpredictable. Clear? So basically we have to be think over all these factors. Clear? Regarding all these factors we have to be think over at that place there. Okay, so kindly remember these things that is regarding the investment decisions. Clear? That is basically regarding the investment decisions. Now further. So capital budgeting. Clear? So here therefore that is capital budgeting. Therefore, for such projects or investment, it requires deep analysis of the investment. The issues faced by an international entity are quite different basically compared to a domestic businessman. So these arise out of the differences in the work culture, legal system, currency system. Main role that is currency system also plays here. Business traditions, accounting standards, trade barriers, local language, and so on. So therefore, we need to analyze all these major issues as a part of capital budgeting, basically for the international project decisions. So this will be a one question. So while discussing the question, you will find issues are where this question basically will be formulated. So basically when we are formulating the questions, so this will arise one question. Clear? Like what are the differences basically they will face? So first one that is the work culture. Second one that is the legal system. Third one that is the currency system. Fourth one that is the business traditions. Fifth one that is the accounting standards. Sixth one that is the trade barriers. Seventh one that is the local language, and so on. So therefore, basically, we need to analyze all these major issues as part of capital budgeting for the international project decisions. So how the currency plays their role? Clear? So how the currency plays their role? So foreign investment analysis. So special consideration, that is basically for what? Foreign and home currency cash flows. Clear? That is special consideration basically we have to give, that is under the foreign and home currency cash flows. Like you are sitting in India and making investment or setting up a project abroad. Clear? Like you are sitting up in India and you are making investment or setting up a project in abroad. So your spending basically will be abroad in that country currency. Clear? Like basically you are investing in the US. So you have to invest in the dollar. Okay, so that is basically in the, like you are investing in the UK. So you are going to invest in the pound. So in that currency, basically in that currency of the country. So your spending basically will be in abroad in that country's currency. Your entire projection basically will be in the foreign currency. Adoption of a currency conversion rate. Like basically you have a rupee to dollar or rupee to pound. So there will be continuously change in this rate. So adoption of a currency conversion rate, particularly basically for the cross currency transactions, will need care and efforts. Clear? Basically that will need care and efforts. So if the project implementation time it is long, so the foreign currency valuation can pose problem. Okay. So if the project implementation time it is long, the foreign currency valuation can pose problem because of the rate volatility. Clear? Because of what? Because of the rate volatility. Your imports and exports, borrowings and repayments, dividends and repatriation. Clear? Import and export, borrowings and repayments. Clear? What you have borrowed, what you have done a repayment. Dividends and repatriation, that is basically funds transferred to the country. All will be the rates fluctuating basically from time to time. Further, elaborate workings and spreadsheets, including for estimates, basically will be required here. Clear? Just you have to remember main thing here, that is to be their currency conversion rate. Clear? We have to be control over, not we can do control over that. Basically, we have to be check over that. Clear? So how much fluctuating the rate basically will be going on presently. Now move to the next one. So one case, one may have to keep updating or revising in case of major exchange rate fluctuation. One may have to be work on multiple scenarios. How basically we can protect ourselves basically from these major exchange rate, or basically we can say that big fluctuations. Clear? We will also discuss later on. So one may have to work on multiple scenarios. Moreover, the foreign investment cash flows made in the relevant foreign currency may need integration basically with the Indian cash flows. If the activities are integrated or the project cost benefits are shared, both between the overseas output and the local entity. Clear? So basically, if the project benefits, clear, we can say that activities are integrated, or the project cost, clear, basically both are involved. Clear? Basically like foreign members and local. So we have to be requirement of the both the currencies. Clear? So one has to make a choice about the currency on the basis of which one is dominant from the project point of view. Clear? From the project point of view, but basically we have to select. Clear? And basically in which currency basically we have to be deal regarding that. Clear? Because while doing business in the two currency, it is very difficult to manage. Clear? Like continuously exchange fluctuation basically it is to be going on. So we have to be take care regarding that. Next one, that is the foreign currency discount rate computations. Clear? Foreign currency discount rates computation. So converting local currency. So how we can convert? There are different types of the rates, and you will get the question on the basis of that also. Clear? Conversion. Converting local currency into foreign currency, it is done at a prevailing rate, which is called as the spot rate. Clear? Spot rate basically what is that? Basically like we can say that presently you are going in the market and for exchange of the currency, and they say that $1 it is equal to the rupees 69.70. So that rate basically it is to be known as the spot rate. Okay, so even spot rate basically varies from one form or mode of the currency to another form, such as currency notes. Clear? So you can also convert that. Clear? Even spot rate basically varies from one form or mode of the currency to another form, such as currency notes, traveler's checks, telegraphic transfer, etc. However, if you want to contract for purchase at a future date, clear? However, if you want to contract basically for purchase at a future date, so the rate called the forward contract rate, it is to be adopted. Clear? So in that case, which rate basically we have to be adopted? That is the forward contract rate. Basically, it is to be adopted in that case. Clear? The forward contract rate basically it is to be adopted in that case. Okay, future date. So like 1 month, 2 month, 3 month forward rate. Clear? So if you want to sell your local currency to buy, we can say that USD at a future date. So there will be discount to the value of your currency because you will have to be future premium also. Clear? Along with that, basically, if the currency it is to going to be rise, so basically we have to pay the future premium also in that case. Okay. So future contract rate needs to be adjusted by the interest rate and the time factor, which we have to be cover in the numerical. Clear? How it will impact. How the time period basically plays their role. Just go through the video basically which I have posted yesterday. In that it also help you like basically how we can, like if we have the interest rate of two countries, clear, interest rate of two countries and the rate of currency of one country, clear. So how we can find the currency rate of the another country, clear, basically with the help of the interest rates. Now move further. So to calculate the forward rate, we have to multiply the spot rate. Clear? To calculate the forward rate, basically what we have to do, we have to multiply the spot rate by the ratio of interest rates and adjust for the time until expiration. Clear? So basically to calculate the forward rate, basically we have to multiply the spot rate by the ratio of the interest rates. Clear? How the ratio basically we have to use and adjust the time until the expiration. So thus this aspect of currency rates, it is an important aspect while conducting the exercise of capital budgeting basically for the foreign investments. Clear? So basically with the help of this one, clear, that is spot rate into 1 plus R1 like R they have given 12%. So basically we will use it at 0.12. Okay. I will help you to understand with the help of questions here. So please tell fast up to this much point. All of you are able to create a scenario in your mind, basically how the process it is to be going on here. How the business basically which we are going to conduct in the foreign country. Clear? How or basically we are going to start any project in the foreign country. How it will be going on. Clear? Just you have to imagine all your situations in your mind. So now next one. Very important 1 mark question. So how much money we can send basically foreign? So international portfolio, basically international portfolio investment, IPI, international portfolio investment, and institutional constraints, clear, and institutional constraints. So with increasing globalization, the trade and business have spread much beyond the domestic buyers. People look beyond their countries to set up the projects and invest in profitable business. Countries like India have started allowing the residents basically to send money under simpler guidelines basically to abroad for various purposes, basically including the investment. Clear? So like countries like India basically have started allowing the residents, clear, have started allowing the residents basically to send money under simpler guidelines to abroad, clear, basically to the abroad for various purposes, including the investment. So presently in India, an individual, how much amount? Clear. So this will be the one question. So how much amount basically an individual basically sent per financial year? Clear. So presently in India, basically an individual can annually send an amount equivalent to USD 2,50,000 US dollars, clear, per financial year under the liberalized remittance scheme, clear, under the LRS. Although under the liberalized scheme, a lot more purposes are allowed, clear. So what are the things we have to be covered one by one, clear? So kindly remember that under the liberalized remittance scheme, basically how much amount basically an individual sent, that is USD 2,50,000. This much amount basically an individual sent basically under the liberalized remittance scheme basically per financial year. Earlier these limits are different basically, but you have to go with the updated limits, clear, but you have to go with the updated limits here. Now move to the next point. So the introduction of the investment alternatives such as the international mutual funds, country funds, and international listed stocks, which allows the investor to achieve internationally diversification without accruing the excessive cost, has also contributed to the buoyancy in the portfolio investments. Okay? Like even we can also invest in the foreign country stocks. Okay, so there are the ways basically for all these things, and we have to be check over that. So now further. So we need to know and understand that is the international portfolio investment means and includes investment, where the international portfolio investment basically means and includes investment into the foreign securities, which can be in the various forms, clear, into the foreign securities basically, which can into be the various forms such as treasury bills, mutual funds, clear, which can be in the various forms such as treasury bills, mutual funds, listed equities, debts to instruments, etc. So this involves the cross-country remittances through designated international fund transfer channels. So the remittance basically will be always in the local currency of the country where the investment basically takes place. Clear? Kindly remember that we have to be send the funds, clear, in that country currency, clear, or we can say that in the locals country currency. Okay, I will repeat once again. The international portfolio investment basically means and includes the investment into the foreign securities, clear, basically where we can invest. One mark question, this one it is also. Okay, so kindly remember these things. You will see all these points in the form of the questions. Clear, which can be in the form such as treasury bills, mutual funds, listed equities, debt instruments, etc. So this involves a cross-country remittances through designated international fund transfer channels. So the remittance basically will be always in the local currency of the country where the investment it is going to be takes place. Clear, the remittance basically will be always in the local currency of the country where the investment it is going to be takes place. Now move to the next one. Benefits. So developed and industrialized markets or fast developing markets offer good opportunities. Clear? So developed and industrialized markets or fast developing markets offer good opportunities. So there are varieties of products available. Information, analysis, and studies too are largely and easily available. Clear? All these things basically for regarding the foreign news, there are a lot of information it is to be available here. The stability of the exchange rates of the developed countries provides a safe value and a lesser risk of exchange fluctuations or erosion of investment value. Clear? Further, that is the stability of the exchange rates of the developed countries provides the safe value and a lesser risk of exchange fluctuation. Clear? Provides a safe value and a lesser risk of exchange fluctuations or erosion of the investment value. Clear? Lesser risk of exchange fluctuation or erosion of the investment value. Further, that is the investors may be able to achieve higher returns. Clear? Investors basically may be able to achieve the higher returns with the reduced risk. Clear? Investors basically may be able to achieve the higher returns with the reduced risk. How basically they can achieve that? Basically by diversifying their investable resources internationally. Clear? By diversifying their investable Clear? Basically, where we have to invest. Clear? Diversify. That is, we have to be invest in the different places. Similarly, also like basically in India, basically if you are going to invest, so you have to invest in the different places, so that if at any particular place you will face the risk, or there will be loss of capital, or we can say that loss, so in the another basically you will earning a profit. Okay, so these things you have to be take care regarding that. Okay? So first point we have discussed regarding the IPI, that is international portfolio investment. Now we have to cover the benefits of that. Now next one, what is the meaning of the diversification and what are the barriers basically which are arises here. Clear? So diversification. So investors basically will usually follow the principle of diversification to ensure a reasonable and steady return along with the safety of funds and benefits of capital appreciation. So this is easier in the case of international scenario. Diversification of investable resources and building of investment portfolio comprising securities of the different companies across the national markets offers the opportunity. Clear? Comprising securities. Clear? That is basically we are, it means that basically we are going to purchase the securities of the different companies. Clear? Comprising securities basically of the different companies across the national markets offers the opportunity of achieving a better risk return trade-off than by investing solely, that is basically on the other place, that is in the place of investment only in the domestic securities. Clear? In the place of the or investment going to be done only in the place of the domestic securities. Basically we have to invest also in the foreign securities also. That is the meaning of the diversification here. Now next one, that is the barriers. What are the barriers basically which we have to face? Basically we may sometimes find impediments and barriers in the capital flow in the long term investments. In the long term investments, the risk is higher. Clear? In the long term investments, the risk is higher because events creating uncertainty in the political or economic field may likely crop up. Clear? Like basically we consider that sometimes basically there is a political instability, it is going to be in the country. Clear? Or basically we can see that they have changed their economic policy, so that will lead to the loss to you. Clear? So you have to be take care regarding that also. So in the long term investment, basically the risk is higher because events creating uncertainty in the political or the economic field may likely to be crop up. Foreign country basically may impose, clear? Foreign country basically may impose price controls with the view. Clear? Foreign countries basically may impose price controls with the view to achieve their fiscal and monetary policy or social objectives. Even language barrier basically may result into disadvantage in obtaining quick and reliable information. Clear? Sometimes basically you are not able to understand the language. Clear? And that will also creates a problem. Clear? That will also creates a problem. That is, it is also one of the barrier. Clear? So in the examination, if they ask a question regarding that, clear, what are the barriers? Clear? Definitely you will get these types of question in the examination. Clear? So what are the barrier here? That is first one, that is the, we can say that uncertainty basically in the political or economic field. Second one, that is the language. It is also one of the barrier here. Clear? Uncertainty in the political or the economic field here. So asset allocation. Now next point which we have to cover here, that is regarding the asset allocation. So efficient management of the foreign portfolio quite heavily depends upon the asset allocation. Once you decide the investment objective, that is where you want to invest, you need to select the right mix of the risk and return to achieve targeted and right mix of the risk and return to achieve the targeted return during the investment tenure. Clear? Like we can say that basically we have to take risk also, and we have to invest basically in the risk as risky asset, and we have to invest basically in those assets also, basically where we get less return, but definitely basically we will get a return from that. Clear? Like in India, basically you want to invest in the FD also, or in the mutual funds or shares also. Clear? So here basically you will get the guaranteed return as per the market. Okay. So such a skillful selection basically will allow the management to passively manage it rather actively. Required liquidity to quickly honor redemption request shall be taken into account. Clear? Required liquidity to quickly honor a redemption request. Clear? Like basically we can say that if you want your funds, clear, so that also there will be quickly redemption basically will be takes place. Clear? Okay, so required liquidity to quickly honor redemption request shall be taken into account and yet avoid idle funds. So securities having less liquidity in the market basically may create problems at the time of exist. What is the meaning of that? Like basically you have purchased that type of securities, basically where there is no buyer of that, clear, where there is no buyer of that, clear. So at the time of the redemption, clear, basically if there is no buyer, so basically it becomes very difficult to liquidate, clear. So it becomes very difficult to liquidate, clear. So you have to be take care regarding that also when there is a no buyer of that particular thing. Okay, so securities have less liquidity in the market may create problems at the time of the exit. Clear? So nowadays there are adequate market mechanisms to easily identify the high rated securities, or basically we can say that basically those securities which are higher in demand in the market. Further, so there are numerous classes such as small cap, mid cap, large cap, high P, low PE, value stock, that is high book to market price ratio, growth stocks, that is low book to market price stock, clear, rated, unrated, treasury and government bonds, debt securities, listed, unlisted, private placement, IPO, initial public offering, future public offering, OPFS, to choose to suit the objective. Clear? So there are a lot of the classes presently available. Basically, where you can invest, clear, as per your requirement or as per your need. Okay, so please tell fast regarding all these things what we have covered till now regarding the capital investment decisions. Why I am discussing all these points? Because in the upcoming session, when we have to cover the numericals, these things basically play their role also directly or indirectly. Even all are to be seems to be theory, but at that place, it helps us to also in the numericals. So any doubt, any query up to this much point? Hope it is clear to all of you up to this much point. So in this session, we have to cover up to this much point. I will show you basically in the next session. First of all, we will start with the hedging strategies. Along with that, this one, it is very, very important example. Like CCS Technology Limited, clear, like they want to invest in the China, clear. And like basically they will require the land, they will have to be near the office. And after the completion of the project, they will sell the land, all these things. Along with that, they have also tell they how to raise the money from the market, basically by issuing the shares. What is the price of the shares, how much annual sales they have to be done, that all that things we have to be covered in this question. And after that, we will try to identify the expected future cash flows in the China and determine the net present value of the project in the Chinese yuan. Okay, all these things we have to be covered. Like this formula, expected exchange rate as per the interest rate parity. So in that video, basically we have to use this formula, that is the interest rate parity. I will share once again in the group. So just go through that, clear. With the help of that, you are able to understand, clear. These are the different interest rates of the two countries. Not basically we are going in the question. So like the nominal interest rate in the India and China, it is to 12% and 10%, clear. And this one, it is the spot rate of the one Chinese yuan. It is to be 9.50, clear. Just basically we have to be used that 9.50. This is the Indian currency. So basically we will take the Indian rate 1.12%. It is to 1.10. Sorry, 0.12. It is to be China 10%. So it is to 0.10. Just we have to use that and we will calculate the rate. Here it is to be n. For first year, n is equal to 1. For second year, n is equal to 2. For third, clear. In this way, basically, we have to be calculated. Okay. Using the formula of the interest rate parity. So thanks to all of you for joining this session and try to understand some basic points regarding that. In the next session, we will discuss further regarding all these questions. So thanks to all of you for joining this discussion.